Today we're looking at fundamental analysis versus technical analysis. We're going to talk a little bit about each of them, compare and contrast the two methods, and also investigate some of the pros and cons. So do keep watching to the end of the video so that you get to hear all the information. Hello, I'm Peter Martin with Trading 212, and we add educational videos about investing to YouTube regularly. If you haven't already, make sure you subscribe to our YouTube channel so that you get to know whenever we add a new video. So let's get into the details of fundamental analysis versus technical analysis. They're both ways of trying to tackle a question that's always of interest to investors, which is whether a company is cheap or whether it's expensive. And really they come at the problem from different directions. Now, fundamental analysis and technical analysis are not methods that are restricted to investing in shares. They're used by lots of different types of traders as well. So FX traders, bond traders, they'll all use fundamental analysis or technical analysis, or maybe a combination of the two in different ways. But for this video, I'm really approaching the methods from the perspective of an equity investor. So let's start with fundamental analysis. Fundamental analysis takes the view that it's economic forces that drive prices. So why not investigate the economic nuts and bolts of a company in order to work out whether it's cheap, whether it's expensive, or whether it's the right value. So let's look at this in a bit of detail. So with fundamental analysis, we're using available data to gauge a share's value, taking the time to evaluate all the information available, really anything that's out there that affects the company economically. And this can come in the form of quantitative information or qualitative information. Quantitative means the hard numbers, things that can actually be counted. As the name suggests, it's to do with quantity, whereas qualitative is all the stuff that can't be measured numerically, the intangibles, if you like. And as the name suggests, this is to do with quality of the company, the essence or character. And so let's look at some examples to further illustrate these two terms. So some examples of qualitative information. We have things like brand value and brand recognition, and the management of the company, the people who are actually running it, what their track record is, what do they have to say about where the company's going, and then some examples of quantitative information. We have dividends and earnings and sales and book value, things like these. And then we can actually compare these pieces of information to price with what we call valuation ratios. So price to earnings and price to sales and price to book value. And I've actually made a series of videos about these, so do check those out if you want to learn more about each of those valuation ratios. Now, for both quantitative and qualitative information, these together help us learn more about the financial health of a company and its prospects for growth going forward. Now, in contrast, technical analysis says all those things that fundamental analysis is worried about, things like dividends and earnings and who's running the company. We don't need to worry about those separately, because what we're going to assume is that all those things are already reflected in the price. So let's just look at what the price has been doing. So let's talk about this in a bit more detail. As we said, technical analysis assumes it's all in the price, so to speak. And so a technical analysis purist might say that effectively everything they need to know is in the charts. And at a basic level, just the chart by itself does offer a visual summary of what a stock has been doing. That tells you a lot more than just staring at price tables. But beyond this, we have this concept that looking at historical price data can be a guide to the future, the idea that what has happened before might tell us a little bit about what is yet to come. When we talk about looking at what price is doing and has been doing recently, this is basically what we refer to as price action. Some key concepts here are things like support and resistance, trends and trend lines, price breakouts, things like that. Do check out my video on the reasons behind support and resistance if you want to learn more about those. And alongside recognizing price action, we have a host of technical indicators available to us, and you'll find all the key ones in Trading 212's app, things like moving averages and oscillators and measures of volatility. And by volatility, we mean how much price has been moving. So for all these things, price action and technical indicators, these are just looking at price charts with no recourse to the fundamentals. So now that we've covered what we mean basically by fundamental analysis and technical analysis, let's take a little dive into whether there are any benefits or any drawbacks from using the two different methods. With fundamental analysis, one of the key assumptions is that the share price will reflect fundamentals in the long run. An investor relying on fundamentals may see that a company is undervalued and therefore buy shares in the company and be confident, because it's based on hard data, that it will in time increase in value. But we don't know when. It tells us nothing about the timing, only that we think eventually it's going to happen. So a bit of a drawback there. Also, because there is so much fundamental information available, financial statements and analyst calls and balance sheets, RNS announcements, that to stay on top of it for one company takes quite a chunk of time. And to do it effectively, it means looking at lots of companies. So fundamental analysis is time consuming. As we said in our intro, technical analysis looks at things from a different direction to fundamental analysis. Whereas fundamental analysis looks at economic factors driving price, technical analysis can clue us into things like sentiment and speculation, things that fundamental analysis doesn't look at. And we can also use our technical tools to gain trading signals and therefore inform our timing for an investment. So fundamental analysis might tell us a share is undervalued and therefore we know we want to buy it. Technical analysis might be able to help us find an optimal time to buy it. So is one method better than the other? Well, it doesn't have to be an either or situation. In my experience, a lot of investors and traders do tend to use a combination of both, even if they lean heavily in favor of one over the other. Even someone who's heavily in favor of technical analysis is unlikely to ignore if a CEO has left a company or if the earnings are extremely weak. Looking at it the other way, someone who is heavily in favor of fundamental analysis is probably still going to cast their eye over a chart just to get a feel for what the company's price has been doing. From my own personal perspective, I want to use all the tools that are available. So if there is any benefit or edge to be gained from one of the tools, why not use it? Also, in my experience, I would say that the longer term investor is more likely to lean on fundamental analysis, and taking that to an extreme, a fund manager who's dealing in investments that are going to last years and years and years might not use technical analysis at all and just purely base their decisions on fundamental analysis. And the other way, very short-term traders might lean heavily on technical analysis. They tend not to be investors though. So if you have someone who's called a scalper in the FX market where they're in and out very, very quickly, they might be dealing purely technical. But as I say, in my experience, a lot of traders tend to use a combination of both. So let's just talk about this in a bit more detail. So which to use? Well, this diagram illustrates a sliding scale of usage from 100% technical analysis there on the left to 100% fundamental analysis on the right. And in between, there'd be a whole variety of mixes, far more than I've shown here. These are just to give you a rough idea of what I'm talking about. I've given them some arbitrary terms. Technical analysis purist is our 100% technical analysis guy. Warren Buffett is there on the right as a 100% fundamental analysis guy. And then a heavy technician might make most of their decisions using technical analysis, but might keep an eye on things like earning reports or pay attention to major macroeconomic releases. Ambi trader is a term I've just made up. It represents someone who's half and half. Maybe they use technical analysis to confirm the decisions they're making from looking at the fundamentals, or maybe they use technical analysis as a way to time their entries and exits after deciding what to do based on the fundamentals. And a casual chartist is someone who heavily focuses on fundamental analysis but might cast their eye over a chart every now and then. And I would say that we might describe these people on the left as being more like traders and those on the right as being a bit more like investors. Though this doesn't necessarily have to be the case. Ultimately, it's up to the individual, and the golden rule, as always, applies: use what works for you. Well, I hope you enjoyed this look at fundamental analysis versus technical analysis. If you did, please hit the thumbs up button and give us a like. Or why not let us know what you think? Which method do you prefer? Send us a message in the comments section. We do read each one. Well, that's all for now. From me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. Goodbye.